So the Federal Reserve just reduced the federal funds rate down to near zero and injected $700 billion in quantitative easing. So today I'm going to break that down for you and go over how it's going to impact you in a negative way, impact you in a positive way, and it's a very scary indicator of things to come. So let me break down that first sentence for you. The Federal Reserve is the central banking system of the United States, and the federal fund rate is the interest rate that they charge when they lend money to other large banks. This rate then influences what interest rate those banks charge when they lend money to consumers. Quantitative easing is the process of the government creating money and then injecting it into the US economy, in this case by buying 10-year treasury bonds. Both quantitative easing and lowering the federal funds rate are both tools that the US uses to stimulate the economy. So how is this going to impact you? Well, in a lot of ways. Some of them are pretty good and some of them are not very good at all. So let's start with the negative ways it's going to impact you. So first off, interest rates that you are earning on your savings account are going to be slashed to near zero. Interest rates on savings accounts are already been at record lows for the last decade, but believe it or not, they are going to go even lower. Even the so-called high yield savings accounts that are advertising maybe a 1.8% interest on your savings account, they're going to get slashed to almost nothing. And at the same time, inflation is probably going to go up. The US is literally just creating this money out of thin air to buy these treasury bonds. So anytime that they create more money, the value of everybody's money is going to go down. So as a consumer, inflation is a bad thing. It means that the value of all the money that you've saved up is going to go down slightly. But from a macroeconomic perspective, inflation is actually a really good thing. So let's say your money did not go down in value. That's inflation. They print more money and all the money goes down in value because there's more in circulation. Let's say it didn't do that. Instead, you had deflation, where the value of your money actually goes up. What you would see is that consumers simply would not spend as much money. If you knew that your money was going to be worth more next month than it is right now, a lot of consumers would be much more hesitant about spending that money because they know that they're missing out on potential gain. This is why all economies around the world follow this model of consistently printing more money to create artificial inflation. When you know that your money is going to be worth less next month than it is right now, you're incentivized to spend that money. And this is what helps stimulate the economy. Robert Kiyosaki, the author of Rich Dad, Poor Dad, says that if you are a saver, you are a loser. And pretty harsh words, but what he means by this is that if you're just saving your money, that money is losing value every single day due to inflation. It's literally just worked into the system that all money loses value over time. So in a nutshell, the Fed lowering the federal funds rate and implementing quantitative easing by printing money and then buying bonds with that money is going to be punishing us consumers for saving money. They're essentially doing this in two ways. One, by eliminating any interest that we would have earned on that savings account, and two, by increasing inflation. Our money that we're saving is now going to depreciate in value much quicker than it was prior. And their hope is that this is going to incentivize consumers to not save money, but instead go out and spend that money in the economy or invest that money into the markets. But to be fair, there probably are going to be some positive effects to the Fed lowering the federal funds rate that are going to impact you as well. So like I said before, the federal fund rate greatly influences the rate that the banks lend money to the consumers. So we're most likely going to see a huge drop in the interest rates that banks charge consumers for things like car loans, personal loans, credit cards, probably home equity line of credits, and probably student loans. So if you're the type of person who saves up all your money and doesn't have a lot of debt, you're probably not very happy right now. But if you're like the average American and you have virtually no savings and you have a lot of debt, this is actually a really good thing for you because you may be able to consolidate all of that debt under one loan with a much lower interest rate. We most likely will also see a drop in mortgage interest rates, which will impact a lot of people in a very good way, but it won't be instant. Mortgage rates and the federal fund rates are not always exactly in sync with each other, but they generally move in the same direction. Mortgage rates do have a lot of other factors that influence them. For example, we were seeing interest rates around 3%, and what was happening is a lot of banks and lenders were getting overwhelmed by the number of homeowners who were trying to refinance their loans. So what we saw was a lot of banks and lenders actually increase their interest rates to help manage and slow down this huge wave of homeowners refinancing their mortgages. But I really am expecting to see mortgage interest rates drop in the upcoming weeks in reaction to the this federal funds rate. So in general, the actions that the Fed took is going to make it easier for consumers to borrow more money, and the hope is that the consumers will then spend that money, and this will help re-stimulate the economy. So if you do have any outstanding debts or any types of loans, this may be a great time to try to refinance them, or even take out a home equity line of credit and try to consolidate all your debt under that one loan. Now, you do want to be careful with home equity lines of credits because they are a variable rate loan instead of a fixed rate loan like a mortgage. So what this means is when the Fed eventually does raise their federal funds rate, your interest rate on your HELOC will also go up. But in my opinion, they're probably not going to do that for a few years. And even when they do, that interest rate's probably still going to be significantly lower than your credit cards. But regardless of the pros and cons, the Fed cutting the federal funds rate is still a very scary indicator of things to come. So if we go back to this chart here, you can see the federal fund rate going back about 70 years, and the gray bars are when we entered into a recession. And we can see a pretty clear trend on this graph. If we look at 2007, we can see that they cut the federal fund rate right before we entered into the 2008 recession. If we go back to the 2001 dot-com bubble, again, we can see that they cut the federal fund rate right before we entered into that recession. And if we go back to 1990, they were a little late on this one, but this time is more of a reaction to us entering into a recession. And we go all the way back to the 1950s, but the Fed lowering the federal fund rate has always been a reliable indicator of or a reaction to the US economy entering into a recession. In my opinion, this is most likely what this is indicating right now. So if we look at the definition of a recession on Wikipedia, it reads, in economics, a recession is a business cycle contraction where there is general decline in the economic activity. Recessions generally occur when there is a widespread drop in spending. A widespread drop in spending is exactly what we're experiencing right now and predicted to continue to experience for several months. We're already seeing amusement parks, restaurants, events, and businesses closing down either voluntarily or as a result of a government order. We're also seeing more and more people self-isolating themselves in their own homes, which means they're spending less money in their local economy. The Federal Reserve obviously sees this as a trend that is going to continue for some time, which is why they took the unexpected actions that they did. Now, what really concerns me about them dropping the federal fund rate is that this has always been their go-to move to stimulate the economy. In previous recessions, they have lowered the funding rate, but they always had lowered that they could go if they needed to. But since our funding rate was already so low to begin with, dropping it to near zero is a card that they can only play once. If this Hail Mary does not stimulate the markets, then we're going to be entering into completely uncharted territory. The only place to go from here would be negative interest rates, which the US has never done. And negative interest rates are exactly what they sound like. The bank will literally pay you interest to borrow money from them, and the banks will charge you interest for them holding onto your money in a savings account. This is an extreme method to incentivize consumers to spend money and punish them for saving money. And this sounds crazy, but we've actually seen several countries in the last few years go into negative interest rates. And we cannot rule out that the US may go into negative interest rates in a desperate attempt to pull out of this upcoming recession. On paper, this theoretically could work, but like I said, we're going into uncharted territories here, and nobody really knows how the global economy will react if the US does go into negative interest rates. If you want to learn the 3 ways that the recent global events is going to impact your real estate market, check out this video I did right here. And if you want to learn more finance and real estate strategies, subscribe and hit that little bell icon to get notified every time I upload a new video. Thanks so much for watching, and I'll see you over in the next video.